Welcome students to the another lecture in the series. Let's begin another important topic today. In the last lecture we studied about financial statements. Financial statements we know very well, the balance sheet and P&L account basically, and we do have more of the statements like funds flow statement, cash flow statement. Basically what is the basic purpose to have these statements is to analyze the situation, to have the data, financial data collected at one point so that we can perform further analysis on it. Okay, so under this first part of your unit 2 financial analysis, we are moving towards the next topic, that is concept of financial analysis. In this topic, first of all, we will try and understand that what is financial analysis, how many types of financial analysis are there, and what is the basic significance and purpose of analyzing the financial statements. Like, why do we perform this analysis? If you see the dictionary meaning of the term analysis, this means that to study a particular thing and to give interpretation over it, that what have you studied, like what are the inferences that you can obtain from that particular thing after studying it, right? So analysis of financial statements here mean to critically examine the composition of an item. Why have I put this term critically? Because you know that audit is an important term in financial analysis. We need to find out that at which point, at which place we lacked out so that we can improve it. So this financial analysis opens the gate to improvisation further. It may be related to costs, it may be related to the methods of maintaining the organization, methods adopted by the management, maybe anything related to the organization and its operations. So it means to critically examine the composition of an item or amount which is appearing in the financial statements. And such an analysis requires various analytical tools and techniques that you will be studying in this unit 2. Management accounting will give you a lot many such analytical tools and techniques which actually helps in the analysis of financial statements. So to analyze the data of financial statements and to do it so that to reach a point to derive certain relationship among different variables and different components existing in the financial statements which are significant and are useful for future decision making. Okay, so overall if I sum up this, that what financial analysis is, financial analysis is like having a look at the financial statements, examining them critically and check out the various items or amounts which are appearing in them and the reasons behind them. If we find any point that this cost should not have been occurred or this cost is particularly high, so we perform various analysis for which we use various tools like ratios to check out at particular time the liquidity of the organization, the turnover of the organization and all that. We can even perform the comparisons with the previous years, that when we opted a particular strategy, how the profits turn out to be. When we changed the strategy, how it affected the level of profits, how it affected the goodwill of the organization, our reputation went up or down due to certain activities or strategies which got changed over the period of time. Okay, let us have a look to a certified definition before moving ahead, because you know that certified definitions are very important in any subject, specifically in accounts. Here I have quoted a definition given by John and Mayers. Financial statement analysis is largely a study of relationships. See this, I'm telling you, relationships among the various items, amounts or variables existing in your financial statements. Financial statement analysis is largely a study of the relationships among the various financial factors in a business as disclosed by a single set of statements. Why a single set of statements? Because at the moment we perform analysis on a single set of statements of a particular year if I say concerned to, and a study of the trends of these factors as shown in the series of statements, and then we perform the comparison over the series of statements. Analysis leads to interpretation of financial data. We interpret the data, which is determining the meaning and drawing inferences or conclusions with regard to the results of significant relationship between the items existing in the books and which are correlated accordingly. Okay. Now let us see the basic types we have in this financial analysis. Uh, See, while we study financial statements, we may have various users and they study the financial statements as per their own purposes. They may have different purposes. So, keeping in mind the requirements of the various parties interested in such analysis, we have classified financial statements into two parts here. First of all, let us see internal and external analysis. When analysis is done on behalf of the management, who have the access to the internal accounting records of the firm, it is called as internal analysis. And such analysis serves the purpose of measuring the managerial efficiency of various functions of the business, so that the internal users can check out at what points they can improve. Accordingly, they may take the future decisions. External analysis, obviously, as the name is suggesting, is done by the external parties, the external users, interested users basically, maybe shareholders, creditors, investors, potential investors, banks, government agencies, who don't have access to the detailed internal records of the firm. So, thus they perform their analysis is dependent on the published financial statements of the firm only, and from there they analyze the financial capabilities of that particular firm. Like if we take an example of an external user bank or a potential investor, they would see that whether the firm is in a good position, is holding a strong financial position over a particular period of time, whether they can invest, they can take the risk to invest in your organization or not. Banks would see your liquidity, whether if you're opting for a loan for any business purpose, whether you will be able to repay that loan in time or not, right? So this is your internal and external analysis. Further, we have another way of doing it, that is horizontal and vertical analysis. Horizontal analysis is that which covers the financial data of more than 1 year, maybe up to 5 or 10 years, and the figures of for various years are presented horizontally over a number of columns. In this, we have certain tools like trend percentages, comparative financial statements. These are certain types or tools, you can say, that are used for horizontal analysis. And sometimes this horizontal analysis is even called as dynamic analysis. Particularly how this analysis helps. This analysis basically helps in comparing the financial data of 1 year with the other. Suppose if we are making a comparative study of the previous 5 years, we can keep the data and we can compare. Suppose if we are comparing the assets in a particular financial year, the assets were this and liquidity was standing at that particular point. We can compare the assets and liquidity of that particular year with the other upcoming years. So this analysis can be performed where we are taking the data of more than 1 year. We may take it for up to 5 years or maximum up to 10 years. Then in this, we have further vertical analysis. Like horizontal analysis is known as dynamic analysis, same way vertical analysis is known as static analysis. It covers a period of 1 year only. There we take it beyond 1 year, but in vertical analysis, the period is of 1 year only and the analysis is made on the basis of one set of financial statements only. Means you choose one particular year, take up the balance sheet and P&L account and perform the analysis. And for such ways. We do have tools like common size financial statements. We do have ratio analysis. These are the tools and techniques that you will be studying in the upcoming lectures, and we will be performing numericals also on these. However, this type of analysis fails to incorporate the changes in the firm's position over a period, and therefore may not be very conductive uh, to perform a proper understanding of the financial position, because we are working on a particular year only. As compared to this, horizontal analysis proves to be more useful and fruitful many a times, because we are comparing different years over a period of time. But vertical analysis is again important, because you are performing out the analysis of that particular year, that how and in what manner the particular year went by, and then you can perform the analysis further horizontally. Okay, and these both horizontal and vertical analysis, it should be conducted simultaneously, because sometimes it's like both types of analysis are indispensable to understand the financial strengths and weaknesses of the firm. Because when you would perform vertical analysis, after that you can compare. Like suppose if we are calculating the ratios of a particular year, and afterwards we can perform the comparison of those ratios. Okay. Let's move further. Then for this lecture, we have one more topic to study further, that is significance and purpose of financial statement analysis. I have quoted few points for this. Let us see. See, your FSA performs essential functions of converting the mass data into useful information. Like you do have a lot many information through financial statements, and from those certain few important points are picked, and then analysis is being performed on those useful points. So let us see first. You can see the first 3 points have used using judging. We do have fifth point also. Why is it judging your efficiency, liquidity, solvency, or efficiency of management? Because you're performing the analysis that over the period of time how efficient we have been. Okay, now let us see one by one these significance and purposes. First is judging efficiency. Here I would like to take a measure profitability. See, profitability is a measure of efficiency because it tells you the success of a business enterprise over a period of time. So a company which earns profit at a higher rate is definitely considered a good company by the potential investors. And these potential investors analyze the financial statements to judge the profitability and the earning capacity of a company, so as to decide whether they would be interested in investing in that particular company or not. So these financial statement analysis helps in checking out your profitability. If you remember, from ratios only we can do that. Profitability ratios are there, which tells you that net profit ratio, gross profit ratio, and other profitability ratios are there. And then you can perform horizontal analysis on them after doing this vertical analysis, that from like over the years, for 5 years or for 10 years, you can see that how your GPR and NPR have changed over the period of time. Next is that judging liquidity. Liquidity, I hope you all are aware, because this is a term that we are using, have been using since the time that you started studying accounting. Liquidity of a business refers to the ability to pay off its short-term liabilities. Means the short-term liabilities for a period of less than 1 year that you are having, that how able your organization is to pay off those short-term liabilities when these become due. And such short-term creditors can be trade creditors, can be bankers. So they make use of that assessment. They make use of the liquidity assessment that is being performed. They are interested in getting to know, to assess your liquidity before granting any credit in any form to your organization. Next is judging solvency. Solvency, it's like it refers to the ability of a company to meet its long-term debts beyond 1 year. That becomes solvency. And I hope you people can differentiate between liquidity and solvency. Both are related to the success of the organization. Liquidity expresses your ability to pay off the short-term loans or liabilities, and solvency refers uh, to the ability of a company to meet the long-term debts or long-term liabilities. And long-term creditors in general are debenture holders, maybe financial institutions like banks or so. So they are very interested in judging the solvency of your organization before lending any amounts or any uh, support from in that particular context. So they analyze the company's profitability over a number of years and its ability to generate sufficient cash to be able to repay these claims. Whatsoever loan they are providing, whether they will be able to claim them back or not. Then in the next we have interfirm comparison, a comparative study of financial and operating efficiency of different firms in an industry is possible only when you have a proper analysis of the financial statements, and it is actually necessary to perform interfirm comparison in this competitive world in order to beat your competitors. So for that purpose, it is also necessary that the financial statements are kept on a uniform base, that the methods of calculating and recording the transactions must not change, so that comparison is possible over the years. And in that situation, not only in your organization over the years you need to be uniform, in that situation financial data of the various firms in an industry are also needs to be uniform, so that they are comparable. Then only you are able to compare, otherwise comparison would not be possible. So interfirm comparison helps you to be competitive. Then judging the efficiency of management. Performance and efficiency of a management can be easily judged by analyzing the financial statements. Thereout you have many parameters. You may check out the profitability, you may check out the operational efficiency, you may check out the cost statements, that how over the years you have saved cost related issues like saving idle time or other wastages of the organization. So profitability of a company is not it is not the only measure of a company's managerial efficiency. There are other ways also to judge the operational efficiency. So financial analysis tells you whether the resources of an organization are being used in the most effective and efficient way or not, so that you can take further future decisions in order to improve your method so that they become efficient and effective. And obviously every management would be interested in having efficient methods in order to flourish further in that particular field. The last function and purpose I have quoted here is forecasting and budgeting. Obviously financial analysis is the starting point of making any plans. Before making any plans further, by forecasting or budgeting, by preparing budgets, you need financial analysis, because unless and until analysis is not being performed, how would you be able to forecast something? How would you be able to budget out something if you're not having a base from the past? So that base from the past or that historic record helps you to take the future decisions, so that you would know that how to take those decisions. So analysis of financial statements of the past years, maybe 5 or 10, or depending on the situation, how much analysis you need, it helps a great deal in forecasting for the future. Okay. Now the next that we are about to study in this unit is the basic tools of an analysis. Today you have understood nicely that what financial analysis is, right? Next, we will be performing this using various tools. Okay. Till then, take care, study well, stay home, stay safe. Bye bye.